Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be answering the question about how annuity companies make their money and what it means to you, especially when you're purchasing annuities. So they got to make money, they got to make a profit. And a lot of people ask, how do these companies offer so much income and how do they stay solvent for so long? Why are they safer than other options out there? And the reason is just what they invest in. Okay, you've got banks that invest very differently, right? You've got hedge funds that invest very differently. And there's different risks involved with different types of investing. With annuity companies, when they're taking your premium, okay, whether you're buying a lifetime income product with an income rider or a SPIA or a DIA or a QLAC, or you're buying a MYGA, which is a fixed rate annuity that pays you a fixed rate of return guaranteed for, however long you decide to lock it up for. They are able to make money with that, make a profit, and also deliver a large return to you in the form of either income or growth or both. Let's go over the indexed annuities first, okay? So, you got different ones. You got variable side. I don't sell variable annuities. They're high fees. The income payouts are not as high as far as guaranteed locked in. I'm not going to talk about that. But I will talk about fixed indexed annuities, and I will talk about MYGAs, which are fixed rate, okay? SPIAs and DIAs, they make the money the same way with those premiums as well, okay? So what you're doing is you're giving a premium to the insurance company, and in return, you're getting a contract back, a contract of income, a contract of a rate of growth or return. And you're wondering, well, how do I get that? And how are they doing this? How are they making this kind of money? Well, what they're doing is very simple. With a fixed indexed annuity, like let's say you put it in with a company like Delaware Life or Lincoln Financial, okay? You put your money in, let's say it's $500,000, and they're going to give you 60% of the S&P 500. You're like, well, how are you guys doing that? Why don't you give me all of it, right? How are you giving me market protection and giving me some of the market? How are you making money? Well, here's what happens. Let's say you give them $500,000, okay, and they purchase a bunch of call options with the S&P index. And let's say that S&P index goes down that year, okay, but they just spent $1 billion. They're not going to make any money, right? Those call options are going to expire worthless. So how do they make a profit? Well, guess what? There's lots of years where the market goes up and they exercise those call options and make a tidy profit. So what they do is that they give you a portion of it, not all of it, because they need to make money, especially to compensate for the years where they cannot exercise those call options. So that's very, very important. So that's why they give you a portion, but not all of it. That's how they're able to protect your money against market risk because it's not in the market. But at the same time, when the index experiences an increase, then they're able to exercise those call options and give you a portion, not all, of those profits. And that's how they make that money. The other way they do it is they buy high-grade corporate bonds, okay? Especially when you're looking at MYGA contracts, these fixed rate contracts, which right now are paying very, very well, and they're usually paying much higher than CD rates are. It's because they're backed by a bond. And what happens is they're able, of course, to make the difference between what that bond is paying and what they're paying you. Okay, so if they're giving you a 5.5%, they might be making 6% total. So they're making a 0.5 point on profit on that. Okay, that's how they do it. That's how they stay safe, and that's how they keep you safe. And so if you were to get out of these contracts too early, and if interest rates were a lot higher than when you bought the contract, and that's for any of these, you would have an MVA charge. That stands for market value adjustment. And that's just because the value of the underlying bond will go down in value, okay, if the interest rate goes up after purchasing the annuity. And so because of that, they're going to incur a loss, and they will transfer that to you if you were to cancel early. So anyways, it's important to know how they make the money so you can understand why they charge the penalties that they charge if you get out early. Okay. And when you're looking at indexed annuities, they'll typically give you a higher participation rate in the index or a higher cap if you commit to a higher surrender charge period, maybe a 7, 10-year, or even some of them are even more than that. But I would say don't go more than 10 years if you can help it. But when you do that, they do reward you with more growth, more potential growth in the index. So anyways, lots of things to think about when you're looking at purchasing annuities, and it's nice to know how they make their money. So I'm going to share my screen real quick. I want you to kind of see what this looks visually. I've done this in virtually all my videos, but I like to do this because it really shows visually how things work on these contracts. Okay, so this is someone who is 62, they're married, their spouse is 60, they're in Vermont, they've got $1 million. Okay, they're throwing $1 million in, and they're going to take income in 5 years. So, and it's going to be joint income for the rest of their life. So right now, Clear Spring is the highest, $101,000, and you got Corbridge, which is roughly the same, and then Delaware, and then Nationwide. So there you go. So you got all the payouts from all the different insurance carriers. And some carriers give you more, some give you less. Just depends on what your goal is. If it's highest income, not as much growth in the account, or vice versa. Okay. When you're looking for income, I typically recommend the highest income products, and then use your other money for legacy. So anyway, so if you look at this and say, okay, well, how does this work? And how is this company making money on this $1 million, right? How are they able to give me this $100,000 payout? I mean, look at this. It's like $3 million. Okay. You're like, they got to make money, right? They can't lose money. Otherwise they wouldn't stay solvent, right? So how does it work? Well, guess what? You just gave them $1 million. Okay. And they've got it for 5 years before they even give you any income. Do you think they're going to make money with that? Absolutely. Okay. When interest rates are high, they can make a lot of money with it. And that's why they're able to give you high annual withdrawals guaranteed for life later on. Okay. So they're making a lot of money in the index, and they're making a lot of money from the bonds. So when you look at that, with a 0% growth rate, they show you worst case scenario. Your contract value goes down. Why? Because they're also charging you a rider charge. They make money off of that too. See? But in my opinion, the rider charge is worth it. I mean, you might pay $100,000 in fees, but you get way more income. I mean, I'll show you. If I was to just say no rider fee, okay, you can totally do that. It's $40,000 less. Okay, so $40,000 less over 30 years. It's like $1.2 million less. Yes, I'll happily pay the $100,000 in fees if I can get more income like that. So it just depends on what you're looking for. It doesn't matter to me. The fee goes to the insurance company. So going back to here, you'll notice we've got the rider charges, and eventually those run out because there's no more account balances at some point. But this, of course, is based off of no interest growth whatsoever in the index. So if you get some from the S&P, you notice they're not giving you very much of it, because remember, for these income products, they're giving you much less of the index because it's a income product, not a growth product. So, but you'll notice the account balance will last a little bit longer, to like 81, 82. So if you pass away, your spouse passes away, your beneficiaries will get whatever's left in that account. And you can see that over here in the death benefit. So, but they're making money. So they made money in the 5 years prior to that, and they're still making money with it during this time when they're giving you income. The other thing to think about is you might die at age 85. Okay. You might not live till 95. Okay. And it all evens out. Life expectancy for a lot of people is in their 80s, but some people live into their 90s and even age 100. And so what you're buying is you're buying peace of mind. Okay. You're buying a pension that you can never outlive. And so they know this, and they're willing to give this to you because they know that some people will die early and some people won't, but it all evens out because they look at the mortality tables. And that's why insurance companies make so much money, even with life insurance. You might be paying premiums that are super low to only, get a huge payout up here, 500,000 or $1 million. And you're thinking, how are they making money? They're making money because they know exactly when we're going to die. Okay, and so because of that, they can structure everything. It's just math. They know exactly how much they're going to make on the bonds. They know how much they're going to make on the index crediting from the call options. They know how much that's going to make them. They know how much they got to pay you, and they got to know, and they also know how many out of thousands and millions of us are going to die and what age we're going to die at. Okay, and because of that, they can give an exact payout and give a guaranteed contractual payout that we know that we'll never outlive. And they know that it's all going to even out for them, because there will be times where they have to pay out. They might lose some money on one or two people, which is fine, but they're going to make a lot on several others that maybe won't live as long. But either way, everyone gets the same benefit: lifetime contractual guaranteed income that never runs out. Okay. So I'll go back here and I'll say, okay, let's see here. We've got contract value doesn't grow very much. And then you've got surrender value. See how the surrender value is less? It's just because if you back out early, they got the surrender charges, especially, and then there's MVA charges we talked about. If those are in the negative, then that will negatively affect your cash surrender value if you were to cancel it. So you just have to remember that. And when you put these into this, these companies are here to make money, not lose money. And so they will pass the losses to you if you cancel early. Okay. All right. So I'm going to go real quick over to the MYGAs, the fixed rate products like CDs. So if we look at these, it's the same thing. They got surrender charges too. I just want to show this to you. So if I was like, let's see, the 7-year, and I want interest only. Okay, I can do the 5.85 and they won't allow us any withdrawals, but if I want some withdrawals, I'll choose this one. So these are the top 3. There's hundreds of them. And again, if you go to my website, johnstevenson.com, you can see for yourself. So if we go in here, this is $1 million, by the way, over 7 years? So there you go. Earnings $57,500 in the first year, and then it compounds. Over time, the last payment's $80,417. You're like, oh, that's great money. Yeah, it is great money. You just made $478,000. You protect your money against market risk. You just got almost $1.5 million back from your $1 million. That's really good. Did the company make money? Absolutely, they made money. Okay, they might be paying you 5.75, or they're getting a 6.25 with it. Okay, so they're making some money. You're making most of it, but they're still making a profit, and that's how they do it. With these, they're just you're looking at high grade corporate bonds that are backing these, and if you take the money out early, here's the surrender charges right here. So after a couple of years, you're at break even. You see the surrender value right here, and it just continues to go up, compared to what the account balance is. So anyways, that's how they make the money. Okay, it's a great way to make money. It's a great way to make a profit, but at the same time, it's a great way to also provide a whole lot of guarantees for the retirement population. For all of us who want to protect our money against market risk, and we want to have the option of having guaranteed income or fixed rate growth, we want out of the market, we want protection. These are great options to do that. Okay, and it just gives you peace of mind. It allows you to not have to think so much about your investments. If the market's going down, you're okay because you got these annuity contracts over here that are taking care of you. And that's why they've been around for hundreds of years. So anyways, if you got questions, you're thinking about purchasing an annuity, please book a call. There's a link below, or go to my website, johnstevenson.com, and check out the annuity payouts yourself. Look at the MYGAs. Okay, look at the rates, see what their payouts are, or look at the income products. If you're looking for highest income, I recommend the income rider. And then at that point, if you're still interested in looking at annuities, then book a call with me. There's a link right there on the website. Anyways, happy to help, happy to answer your questions. If you have questions, make sure you comment below. And if you like the video, make sure you like, subscribe, and share it. And I appreciate you so much. Thank you for watching, and we'll see you soon.